Raising your prices right as you're about to lose your biggest customer is, well, it's a choice. Welcome to Earnings Unscripted. It's July 29th, 2026, and Qualcomm's fiscal Q3 report is giving us a lot to process. The numbers themselves are a bit of a mixed bag. Top line beat expectations, landing right around $9.9 billion in revenue, but they had a tiny 2-cent miss on the bottom line with earnings at $2.21 a share. So, Miro, the stock gapped down hard after hours and just kept sliding. Are people really panicking over a tiny earnings miss?
No one cares about a marginal miss. The market is reacting to the structural walls they're crashing into. It's an interesting paradox. They're stuck paying higher input costs for wafer fabrication, which drag their margins down compared to last year. And at the same time, the CFO basically admitted they're losing Apple's iPhone business way faster than anyone modeled.
Okay, since we're diagnosing a pretty bloody after-hours tape, I should probably toss in that this is strictly our own commentary, not professional investment advice. But wait, back up a second. I thought the Apple phase-out was this long, gradual glide path.
It was. It was supposed to be. Management previously guided they'd hold a fifth of the upcoming iPhone launch. Now they're saying the share is going to be materially lower due to supply constraints. They're projecting a massive sequential drop in Apple revenue by December. But there's a bright spot keeping the thesis alive.
Automotive, right? Because I saw the segment results and it honestly reads like a totally different company's balance sheet.
Exactly. Qualcomm is quietly pivoting into an automotive powerhouse. That division surged 61% year over year. They're locking in these heavy multi-generational digital chassis deals with BMW and Stellantis.
Okay, so I'm trying to visualize this. They're bleeding out on premium smartphones, which basically built their entire modern reputation, and they're trying to fill that gap with connected cars.
Yeah, and it's physically changing how the business behaves. The ripple effects are completely breaking the historical math the street uses to track them.
Right. The CFO literally told analysts to throw out their old seasonality models. I need to know why that flagship holiday quarter is suddenly getting flipped upside down.
It's pure math, honestly. For a decade, the December quarter was their untouchable peak because everyone builds phones for the holidays. But the Apple phase-out is so steep now, it's dragging that entire average down with it. The CFO literally told analysts, quote, "You should not think of previous seasonality where first quarter was the high quarter for us. We actually expect revenues to grow when we go from the December to the March quarter now."
Wow. I mean, they're essentially admitting their most famous growth engine is officially in the rearview mirror. But you mentioned the supply thing earlier. If you're losing a client anyway, why claim you're supply constrained?
Right. That's the most cryptic detail in the entire call. Akash, the CFO, claimed the sudden drop wasn't entirely Apple walking away. He said, quote, "As a result of our supply constraint, we now expect an acceleration in the step down of Apple product revenues starting in the fourth fiscal quarter."
No, wait, stop. Are you implying Qualcomm is firing Apple before Apple can fire them? Like purposely throttling the supply?
I think firing is a bit aggressive. But look at their reality right now. Semiconductor input costs are exploding. Fabs, assembly, testing, it's all getting wildly expensive. If your factory capacity is tapped out, do you waste it printing lower margin chips for an iPhone that's migrating away from you anyway? Or do you allocate those wafers to BMW?
Okay, that makes weirdly perfect sense. You feed the divisions that are actually growing. But if costs are soaring everywhere, how are they protecting margins on their core Android chips?
Brute force. They're implementing double-digit price hikes across their premium silicon to offset the fabrication inflation.
Yikes. In a shrinking smartphone market? That feels like playing chicken with your remaining buyers. If I'm a Chinese handset maker and my memory components are already through the roof, I can't afford a pricier Qualcomm processor without completely wrecking my retail price.
Exactly. And the data shows they're balking. We're seeing OEMs downgrade their bill of materials. Instead of buying the absolute top-tier AI-enabled Snapdragon, they're settling for older generations just to keep their hardware costs under control, which directly hurts Qualcomm's product mix.
So they're hiking prices but getting squeezed on the high end? That's a nasty pinch.
It actually gets tougher. Because right as that premium handset mix softens, they're spooling up their first major wave of custom AI chips for two giant hyperscale data centers. And management warned those specific data center deliveries are going to drag their weighted average gross margins down by roughly 1.5% to 2%.
Okay, wait, hold on. Walk me through that again. I thought data center AI chips were the ultimate holy grail for margins right now. Why on earth would selling custom hyperscaler silicon pull their profitability down?
I know, it sounds totally backward, but it's the physical reality of early-stage silicon. When you manufacture a brand new complex architecture like this high-bandwidth compute logic they're pushing, the initial yields from the foundry are terrible. The upfront tooling and wafer testing costs are massive relative to the first batch of revenue.
Right. It's the first pancakes in the pan.
Exactly. First pancakes always look terrible and cost you a fortune in butter. Over time, the yields improve and margins expand, but right now that data center ignition is an expensive tax on the balance sheet.
It just feels like they're completely remodeling the business from the studs up. They've got the Apple revenue evaporating, they're forcing price hikes onto defensive Android makers, and they're eating the startup costs of becoming a true AI infrastructure player.
And that transformation requires capital and time. Cristiano Amen even got a little defensive with analysts who wanted overnight success in the data center. He basically reminded them that hyperscalers demand physical silicon demos before they sign massive contracts. Quote, "We needed to see silicon and see how it performs before we make a decision that we're marching forward."
So if this entire narrative hinges on scaling automotive and suffering through these early AI chip yields, the real question is how much patience Wall Street actually has for a multi-year rebuild.
Wall Street has zero patience, but management's basically daring them to look past the immediate pain. I mean, sure, for their fiscal fourth quarter, they're guiding total revenues somewhere between 9.7 and 10.5 billion.
Which sounds solid, but obviously that masks the internal churn we were just talking about with the smartphone stuff.
Exactly. Embedded in that guide is the start of the massive Apple drop-off. But they're asking investors to trust the long game. Management boldly stated they're on track to hit $40 billion in non-handset revenues by fiscal 2029. That almost doubles their prior target.
That's a huge flex. But you know what genuinely surprised me? It isn't just about printing physical chips anymore. They bought this AI software startup called Modular Inc.
Oh yeah, the open ecosystem gambit.
Right, but why? I mean, Qualcomm makes chips. Why are they suddenly hosting software developers and trying to break open, closed AI frameworks?
It's absolutely a direct shot at NVIDIA. You can't beat the incumbent on raw compute today, so you try to commoditize their software layer. You want developers to build on open tools so they aren't locked into your competitor's hardware.
Okay, that makes perfect sense. So they're basically arming developers against the monopoly, which is super ambitious, but it also explains why this transformation is so aggressive.
Yep. They're fighting a multi-front war. Losing Apple, hiking Android prices, pushing heavy into cars, and trying to kneecap a giant competitor.
All at the exact same time. It's a huge amount of friction to manage.
It's corporate transformation on hard mode.
We'll see if the street buys that long-term vision or just panics over the handset cliff next quarter. Either way, Qualcomm's basically rewriting its entire identity live on stage. Thanks for listening to this breakdown, guys, and we'll catch you on the flip side.
Always a pleasure. See you next time.
If you liked sorting through the noise with us today, you might want to add this feed to your regular rotation. And just as a heads up, we're completely synthetic, since this entire show is an AI experiment designed to turn dense earnings calls like Qualcomm's into something you can actually listen to the exact same day. We'd love to hear your feedback or what ticker you want us to tackle next. So drop us a note at earningsunscripted@datamadness.ca.
Catch you next time.